Hi, everybody, and welcome to the webinar. Today, we're going to go over three-legged box spreads, which I think is one of the best strategies out there for retail investors. I mean, between anybody who has an account anywhere from just a few $1,000s up to $250,000 or even more, you're going to really enjoy the strategy. I'm excited about presenting it to you, and I want to go through all of the strategies because I think you're going to find it to be a strategy that could make up a core part of your trading strategy. So, as far as I'm concerned, this is all I trade. I've done a lot of different trading over the years. I've done complex spreads like iron condors and calendars, and butterfly spreads and multiple butterfly spreads, and I've done all kinds of futures trading, oil futures, US, foreign currency. Futures. I've done the YM. I've done just about all the futures that you can possibly think of. I've traded those. I've traded stocks. I've traded stocks with options. I've done married puts. I've done collar strategies. I've done volatility strategies. I've traded just about every kind of stock option there is. I used to put 200-300 contracts on a option contract at one time on a particular stock. And I've traded hundreds of thousands of shares of some stocks as well. And so when I go back over the 40 years that I've been trading, I look at all of the strategies and I keep a record of all the strategies that turned out to be the most successful for me, but also those that allowed me to have some freedom and some lifestyle as a trader. Some of the strategies, especially with futures, they don't allow you to do that. I mean, you need to watch those futures all of the time, or you need to put in really good stops, and then we walk away from it hoping that you're going to make a profit, right? But with this strategy, it's what I call it, it's a lifestyle trade, because it allows you to put a trade on and you can really relax with it. It doesn't keep you up at night. And a lot of strategies, I know for a lot of traders will. You put on a trade and you'll worry at night. It's like, oh, what's this trade going to do? If something happens in Asia at 2-3 o'clock in the morning, AM, you're going to be looking at the trade and you're going to say, wow, what am I going to do now? I have to get out of this trade. So this is a trade that has a built-in automatic maximum loss with unlimited profit potential. And so when I looked at all of the trades that I've done over the past 40 years, this one that I've just really started doing over the last 5 years or so is the most profitable, and it also allows me the freedom and the lifestyle choices that I can make on a daily basis. So it gives me a tremendous amount of freedom to be able to do whatever I want, put a trade on, let it run, hit my maximum profit, and I'm out, and I have alerts set up to do that. And if it goes against me, well, the maximum loss is very, very small, as you're going to see. So this is the perfect strategy for small, medium-sized retail traders. You got a few $1,000s, or you got more than that. This is the greatest strategy, in my opinion, that you're ever going to run against. You can try all kinds of different strategies, but this one I think is really the best. We're going to get into it in just a second, but I just want to check. I've got two monitors set up here. I've got one with my screen, and I've got one that you can't see with the chat box in it. And what I want you to do is just let me know if you can see me and hear me okay before we get started. All right, just type in there. Yes, yes, yes. Bill, Pierre, Ben, Tori, Joette, Marlo, Kevin. Great, thanks. I appreciate that. All right, it looks like everybody's good to go. If for some reason you're not having, if you're having an issue and you can't see me or hear me, or you can't see my screen, it should say in front of you the three-legged box trade. Why this is the perfect strategy for small, medium-sized retail traders with portfolios of 5,000 to 250,000. If you can't see that for some reason, please put it in the chat and let me know anytime during the presentation, okay? All right. Now I've got slides here. I've got a lot of material to go through. We're going to go probably about an hour and a half today, just to go through everything that I need to talk about and discuss with you. So it's very important that you pay attention to the entire presentation, because if you miss anything, especially in trading, those little details can really hurt your performance. So I want to make sure that you have everything that you need in order to start creating your own three-legged box trades for your own portfolio. So first of all, who am I? Why am I doing this webinar? Well, my name is David Vallieres, and I've been trading for about 40 years. I actually started when I was about 16 years old. I bought a stock called Syntex, and if you don't know what Syntex is, they're the first company to create birth control pills. And back in the 1970s, well, they actually created them in the late 60s, but in the 1970s they ran into a little bit of trouble back in 1974, and their stock hit about $20. And I heard a news report about it, and I said, this is going to be, this is just a temporary thing, because obviously this is going to be a big product and it's going to make them a lot of money. And so I convinced my father to buy $10 of 10 shares of the company. And for $20, it was about $200. And I had the money at the time because I was working summers doing odd jobs. And I gave him the money. He went down to his broker, and we bought 10 shares of Syntex. Well, in a couple of years, it went up to $180, and I sold my shares, and I made a pretty good profit. And since then, I've been hooked on the stock market. In fact, I created my own indicator. I've done all kinds of different types of trading. I really didn't I've been following the market for 40 years, and I was very serious in my mid-20s. And I started doing some debit call spreads and debit put spreads on various stocks and indexes. I found a course by Hume Publishing called the Super Investor Files. I started reading those and following those trades, and they actually worked out very, very well for me. That was about 1987, leading right up into the October 1987 crash in the market. I did very well until the crash. I actually kind of thought something was going on with the market because it was just too good to be true, because it kept going up. And so I stayed out of the market for a while, and then we had the crash, and then there was quite a bit of volatility. I ended up staying out of the market for a while. And then I just kind of let the market go, and I didn't really trade too much, but I followed it. And I realized during that crash that volatility increased tremendously. And I remember calling my broker the morning of the crash in 1987 and asking him for a quote on a stock. And he said, I can give you something, but I don't even know what it's trading at, because the volatility was so high, and the delays between the floor and the brokers was so extreme that he said I could give you a quote, but it wouldn't mean anything because I'd have no idea what I could actually fill you at. And so I understood how important volatility was at that point, and I made it a lifetime study. We also, excuse me, then I started a business. I really didn't have a whole lot of money to invest at that time. I had a young family. We bought our first house, and I didn't have a lot of money. So I started after I started my business in 1999, I went about 4 or 5 years in my business, and all of a sudden I woke up and found quite a bit of cash in my bank account. And I said, well, I've got to do something with it because it's earning like 1%. And so I started looking at the market again, and I needed, even though I had a really good foundation in option trading because I had done those credit and debit spreads, the debit spreads back in 1987, I had followed the market since then, and I looked for the very best mentor that I possibly could find, and through a connection, I found someone who was a retired CBOE floor trader, and he mentored me for about 2 years. And I started trading again, very, very seriously, very heavily. In fact, I have a report that I did on how I made about $47,000 in a single day in the stock market, and I'm going to give that to you absolutely free as a just kind of a thank you gift for being on this webinar. Towards the end of the webinar, I'm going to have a download link for you so you can download that and take a look at it. And I explain exactly how I did it. In fact, it's a phenomenon that happens about once every, I don't know, probably once or twice a year, and you can make a tremendous amount of money doing it. But it's very reliable and consistent. And these days, I'm looking for reliable and consistent. And that is the most important thing to me in my trading, because I really am, at this point, really looking for a lifestyle trading experience in my life. I'm not interested in watching the market every single second of the day. I'm not interested in day trading. I'm not interested in putting on huge positions where I might not be able to sleep at night with them. I'm looking for something that I can basically put on, walk away, and monitor maybe 15 to 20 minutes a week, just looking at my positions and monitoring it and trading it like a business. So I'm looking at the numbers all of the time. We're going to get into that as well. So that's who I am. You probably know some of the trading courses that I came out with, Trading as a Business, which is also under the brand of Trading Pro System. That was a course that I came out with just after I finished my mentoring with the retired CBOE trader, and I started trading on my own. And I came out with that course to help traders in 2008. And then the Winning Trade System, which was a follow-up system, trading system to that. It was a little bit more basic, a little more directional in nature. The Winning Trade System came out 2010, maybe 2011, I think 2011 or 12. And the Trading Pro System, though, turned out to be one of the best courses on investing. I think that a lot of people, at least a lot of people, told me that it is one of the best courses on trading that they've ever seen. Now, that was meant to be an advanced trading course, and the only objections I got to the course was the fact that it was too advanced, and that I assumed a lot that you had certain types of knowledge about options and volatility and so forth in order to take advantage of that. And so I mean, other than that, people absolutely loved it. It was fun to put together, and I had a lot of fun doing it. I also do a daily update on the markets at Daily Market Advantage, and you can always check that out as well. First, some disclaimers. We've all got to do it these days, but basically, I'm not a registered investment advisor. I am not a broker. I'm not recommending I'm not endorsing, I'm not recommending, I'm not soliciting or offering any stock, future, or option contracts. This webinar is for educational purposes only, the goal of which is to teach a specific and proprietary trading methodology. Let me just emphasize that again. I am not an investment advisor. I'm not an investment manager. I'm not an investment counselor. I don't manage directly or indirectly funds which are not under my direct control and fiduciary responsibility. The most important disclaimer of all, of course, is that any past results of trading or investment systems are not necessarily indicative of future performance of that strategy. So please keep that in mind, and this is for educational purposes only. Please do your own due diligence. All right, what this is not, it's not a day trading strategy. It's not understanding, high frequency trading or HFT. High frequency trading has become really popular over the last couple of years, especially because of computer systems. They've gotten more powerful. High frequency trading is something that you should be aware of, and it has changed the market somewhat. The algorithms that computer systems are using now to trade stocks, I think, was responsible for the 1,000-point drop that we had a few years ago in that single day. Something went wrong there, and a computer hit a program, a trading program, that executed sell orders on a massive scale, and that can happen again. So it's not, we don't have anything to do with HFT. We don't have anything to do with day trading. Like I said, this is a lifestyle trade. And so it's not learning how to scalp. It's not learning anything about futures or stocks. We're going to be dealing strictly with options in this strategy, and it has nothing to do with Forex as well. I know a lot of people are very, very interested in Forex, but I can tell you that this strategy is probably better suited for the majority of traders, and it's more consistent and reliable in its profitability than any other strategy that you're going to find anywhere. What this is, it's a perfect option strategy, I think, for account sizes of $5,000 to $250,000, and I'm going to prove it as we go along here. Here's some benefits of the three-legged box spread. I want you to keep these in mind as we go through the actual spread and how it's constructed. But basically, you have, number one, the biggest one is forgiving economics. You have a high profit and a low ratio of losses. So you've got almost a 2-to-1 ratio in general. Sometimes I look for a 3-to-1 ratio for profit to loss. But it does have very forgiving economics. There's also a lot of flexibility. There's all kinds of variations on the basic strategy of a three-legged box spread that I'm going to give you today. There are so many different variations that you can use. A big one here is longer expirations, and you have time to be right, and you don't have as much churning in your account. You're not paying commissions all the time. When I was trading very heavily, I was paying 20, 30. I think one year I ended up hitting like close to $35,000 a year, and just in commissions to my broker. And so with this type of trade, this is a much higher ratio of profits to losses. And you don't need as many contracts. In fact, as you're going to find, I'm going to go through a track record with you, showing you over about 84, 85 trades that I've done, the last 84, 85 trades. You're only using one contract, and it's extremely profitable with one contract in the spread. You have a clearly defined loss over hundreds of trades. I'm going to show you the track record for the last 80, 85 or so. But over hundreds of trades, the average loss is about $413. You have clearly defined profit targets, and the average profit is about $1,340. So you've got, close to a 2 to 3 to 1 ratio on profit to loss. So you can lose, and I'm going to go through some examples with you. You could lose maybe 2 out of 3 trades and still be profitable. So it's very easy because you're only using 3 options. It's very easy to open and close trades. There's no overnight worries, like I mentioned, with big moves or even assignment of options. And I know a lot of people who, get into options, and it becomes, a bit worrisome that, you're going to get assigned at some point. But because we're using longer term expirations, that's not really going to come into play. It could, but it's not really a big issue. You have clear entry and exit points. They're easy to put on and take off. There's no complicated legs here. You're only talking about 3 options. There's no adjustments necessary. Now, with trading as a business, the Trading Pro system, I taught adjustments, and that was one of the big features of that system. It did get confusing. It did get a little bit, hairy for a while. If you're trying to go in and make an adjustment to a trade, you're not quite sure exactly how you're going to make that adjustment. Also, there was additional commissions that you had to pay on the trade because you were making adjustments. With the three-legged box trade, you don't have to worry about adjustments. There are no adjustments. Either the trade works or it doesn't work. You can do once daily monitoring with alerts, a couple minutes a day, 15 minutes a week, and you're good to go. And with alerts, really, you don't really need to even look at your position until the alert is triggered. And so it's not minute-by-minute trading. This is very relaxed. It's informed and thoughtful trading. You can actually take your time putting on positions, and you can take your time taking off positions. Although when you do hit a profit target, I recommend you take it off right away. It's simple execution, makes the entry easy. Single contracts, like I said, keeps commissions very, very low. And the biggest benefit is it's a lifestyle trading system. So, you can put the trade on, you can go do whatever you want, you can spend time with your family, You can go on vacation. You don't have to worry about these trades. You don't have to worry about stops and stop losses. You don't have to put in stops in the market. And that's one thing that really hurts a lot of traders is when they're putting in stops in the market. You can get easily taken out of the market before the big move happens. And so, excuse me. This has the system, the three-legged box system has a built-in maximum loss that it doesn't automatically get executed for you. You stay in the trade even though there's a maximum loss. Because we do have longer expirations in these trades, there's a possibility that it can come back and it could make it profitable, and that's happened actually a couple of times. So it's a lifestyle trading. This is not something that you need to worry about, concern yourself about. You put a couple of trades on, and sometimes profits come really fast. Sometimes they come a little bit slower. It all depends, but it definitely is a lifestyle business. So this is a picture of my front door when I was on vacation in Cape Cod while I was doing some trading. And, it's a great view. You get to do some sailing. You get to do some boating. You can do whatever you enjoy and still have an opportunity to profit very, very well in the markets. All right. I've got 3 ideas for you that I want to share with you about trading, and then we're going to get right into the three-legged box spread. But this is so exciting to me because, like I said, I've gone through every single type of trading strategy out there. You can't imagine. This one beats everything. I mean, iron condors, calendar spreads, you name it. This is the only strategy that I'll probably trade for the rest of my life. That's how good it is. All right, let's get into a couple big ideas. Know what kind of market you're in. That's absolutely critical. In the Trading Pro system, the ideal environment to trade the Trading Pro system is to trade between when the VIX is between 40 and 20. Ideally, you want to put on the trade at 40 when volatility is at 40 and it's coming down. And so when volatility is taken out of the market, then you want to take the trade off when it reaches 20. At 40, you have premium. So you have premium in the market, and you can sell options at good premiums when volatility decreases. It's coming down into the 20 area. You take those trades off. You've extracted most of the value of those options in premium, and then you take the position off. We haven't seen that kind of market in a while, and that's why I don't recommend using the Trading Pro system today, because right now, at least at the time I'm doing this, even though we've had a little bit of a downturn in the market, volatility is below 20. And anytime volatility is below 20, there's very little premium in options, and time premium I'm talking about. And so it's very hard to make any money selling options. With the three-legged box spread, it doesn't matter what volatility level you're at. You could be you can be in a low volatility environment, under 20, or you can be in a high volatility environment, or you can be in a middle volatility environment. I'm going to show you an example of a trade that we did on Goldman Sachs that was, the volatility was relatively high. It was up in the 50s. But it worked out tremendously well. It works just as well in almost every single volatility environment. And like I said, knowing what kind of market you're in, especially when it comes to volatility, is absolutely key. So in my terms of my definition of volatility, 0 to 20 is low, 20 to 40 is in the middle, and 40 and over is relatively high as far as volatility goes. We talked about the big idea number 2. Run your trading business like a business and manage it by the numbers. And that's what I've taught in Trading as a Business, the Trading Pro system. Manage your trading business by the numbers. And what I mean by that is that the top 2% of all traders have an edge in the market, and that specialized knowledge and skills. We're going to get into exactly what that edge is because there are literally thousands of different trading strategies and methods and instruments that can be traded out there. Specialization is the key to winning in the long term. Simple example, who makes the most money, your family doctor or a brain surgeon? Very simple, right? The brain surgeon definitely makes more money because he specializes in a particular type of medicine. And the same is true for anyone in the markets. If you have if you specialize, and I recommend that you specialize in three-legged box spreads, if you specialize, you're going to make more money. Now, you can specialize in iron condors. You can specialize in calendar spreads. You can specialize in all kinds of other complex spreads, credit spreads, debit spreads, or whatever it is that you want to do. But if you specialize, you're going to make a lot more money in the long term because you'll know everything that there is to know about that particular strategy. But I'm going to show you, and I'm going to convince you, that the three-legged box spread strategy is better than them all. It's better than futures, options, forex, you name it. It's better than almost anything, including, I get a lot of questions from people about weekly options or binary options. And that's gambling. To me, that's gambling. That's not investing. That's not being thoughtful and thinking through your investment strategy at all. That's just my opinion, but I think you're gambling, and I think it's a very dangerous thing to do. I would not do them at all. All right, let's continue here. So it's a business. So as a business, if you think of investment and this trading strategy that I'm going to share with you, it's a business. You have to have an expectation of a profit. If you go into business of any kind, whether you're opening a franchise, if you're opening up a new store, if you're opening up any kind of, retail operation, if you're opening up any kind of a business at all, manufacturing or wholesale or distribution or whatever it might be, you have to have an expectation of a profit. So what is your expectation of making a profit? And so we're going to go through that as it relates to the three-legged box spread, so you know exactly what your expectations are. Okay, I see a question here. Mary, I'm not sure that I am recording this with ScreenFlow that I'm using on my computer. We also are using a service called Meet Often, and I'm using them as to deliver this webinar to you. But I'm not sure if the recording functions are going to be working. Hopefully there will be a replay, but I can't guarantee it. With ScreenFlow, I should be able to render the video okay, but you never know. Sometimes they don't come out well. So, but to answer your question, yes. And yes, we are also going to be having a Q&A session at the end, so I'll be able to answer your questions. But I want to get through the material, and then I'll come back to questions as well. All right. So, let's say you don't win out of 3 trades. You win 0. You don't win anything at all. Well, since our average winner over hundreds of trades that we've been doing this is $1,340, the actual profit obviously is going to be 0. If you don't win anything out of 3 trades, you lost 3 trades out of 3 trades. With an average loss of about $413, you have an actual loss of $1,239. So your net profit or loss is going to be $1,239, not including commissions. But you're only talking about one contract. You're talking about one contract size here. So if you lose 0 out of 3, you lost $1,239 on average. Let's say you win 1 out of 3, which means you lose 2 trades out of 3 trades that you enter. If your average winner is $1,340, the actual profit is $1,340 on that 1 trade that you won. The average loss is $413, and you lost 2 out of the 3 trades. Your actual loss then is $826. Your risk to reward ratio is 1 to 1.64. Your net profit and loss is $514 positive. So this is an example of how the forgiving economics of the three-legged box spread is. These examples come directly out of the three-legged box spread. You've lost 2 out of 3 trades, but you still have a profit of $514 on average. Remember, we're talking about hundreds of trades that we've averaged out, and this is the scenario that we've been running. You lose 2 out of 3 trades, you still have a profit. That's why I say this forgiving economics are probably one of the biggest benefits of using three-legged box spreads. And again, we're only using one contract. What happens if we can increase our winning ratio from 1 out of 3 to 2 out of 3 trades? Now we get into some serious profits here. The average winner, again, is $1,340. We've won twice out of the 3 trades. Our actual profit then is $2,680. We have an average loss of $413, and we lost 1 out of the 3 trades. So our loss is $413. Our risk to reward ratio now is 1 to 6.49, and our profit is $2,267 by just winning 2 out of the 3 trades. So does this happen often? Yeah, it does. It doesn't happen. Does it 1 out of 3 trades happen? Yes, it does. Much more frequently. Does 0 out of 3 trades happen? Yes, it does, because we will have losses, and sometimes you even go into streaks where you're going to lose 0 out of 3 trades a couple times. But generally, you're going to find that you're between 1 and 3 trades and 2 and 3 trades. Generally, over the hundreds of trades that we've done, that's generally how it's averaged out. And then, of course, you can also have winning streaks. So you can go 3 out of 3 sometimes. And the average winner, again, is $1,340. And if you have 3 winners, your actual profit is going to be $4,020. Your average loss is $413, but you had no losses because you won 3 out of 3. And so your risk to reward ratio is really 1 to infinity, but of course it's not infinity. But the net profit and loss is going to be, you're going to win $4,020 just on 3 trades if you get 3 trades in a row. Again, it's with 1 contract size. So forgiving economics is one of the strongest benefits of the three-legged box spread. Studying volatility, I mentioned volatility earlier, increases your winning percentages and profitability. It's so important. Understanding what kind of market you're in is probably the key, or what kind of market you're entering. So for example, today the market is up, next day it's down. Those short-term moves generally don't mean too much. You want to look at the overall trends. And so when you're selecting a potential candidate for a three-legged box spread, you want to make sure that you're looking at the overall market. You want to know what kind of market you're in before you put the spread on. So, like I said, knowing what kind of market you're in really is the key to being in the top 2% of all traders. Now, 98% of the traders lose money, and that's a fair assessment. I think over the 40 years that I've been trading, most people do lose money in the markets. In order to be profitable, you have to be in that top 2%. And in order to do that, you need to do 2 things. You need to have specialized skill and knowledge, and you have to know what kind of market you're in. And then you have to properly use a trading strategy that will allow you to profit when you're right. And that's why the three-legged box spread, I think, is probably the best, because you have a very, very clearly defined loss on every single trade. And you have, even though we have profit targets to the upside when we're right, we have unlimited profit potential with a three-legged box spread, as I'm going to show you in just a few minutes. So what's a box spread? Let me take a drink of water. So what's a box spread? It's a trade that has 4 options. Now, this is not the three-legged trade, but the three-legged box spread comes out of the box spread. And so you need to understand what the box spread is in order to understand kind of the dynamics of the three-legged trade itself. It's a trade that has 4 options at 2 different strike prices that forms a box, which, If purchased for less than the difference of the strike prices, gives you a guaranteed profit. All right, let's take a look at exactly what this looks like on a graph so you can have some visual idea of what I'm talking about. All right, this is an example, okay? Stock XYZ is selling at, is currently trading at $67.50. You'll notice that this is very similar to a option graph that you might see in your trading platform. You have calls on the left side, puts on the right side. Anything in the pink box here, shaded box, is in the money for the calls. Anything that's out of the in the money for the puts is in this shaded area here. These are all in the money. The puts, anything in this white area here is out of the money. And for calls, anything in this white area here is out of the money as well. The basic strategy of the box spread is simply to buy a call at one strike price and sell a put at the exact same strike price. Okay? Then you're going to sell a call at a strike price, and you're going to buy a put at the exact same strike price. That's why there's only two strike prices here. Now, when you take a look at this, you're going to understand some dynamics. I'm going to go through it a little bit. It's slightly technical, but just stick with me here, and I think you'll understand exactly what's going on. This is called a 20-point box spread. We're using the 55 strike price and the 75 strike price. The difference between those two strike prices is 20 points. That's why we call it a 20-point box spread. Now, when you're buying a call, you have a certain delta, right? This particular call at the 55 strike price is in the money by approximately $12 if the stock is selling and trading at $67.50. So the delta of that particular call is going to be positive, and we'll just use an example here, but the delta here is probably going to be like maybe 89. Okay, so we use that as an example. The put, a put, if you bought a put, is going to also have a delta. It's going to be a negative delta. But because you're selling the put, it has a positive delta. So because it makes money when the stock goes up. So, for example, let's say because it is out of the money by about, close to 10, 12 points, it's only going to have a delta of 0.11. Okay? Now, when you add up the deltas, you're going to get what? Add up is 0.89 and 0.11 adds up to 1. So this particular, just this part of the box spread, when you buy a call and you sell a put at the same strike price, the delta is always going to be 1. Does anybody know what just that part of the box spread is called? Peter, yes, it is a spread. Ben? Yes, that's right. Ben has it. It is called a synthetic long stock position. This is a synthetic long stock using options. So when you purchase a call and sell a put at the same strike price, if it has a delta of 1, it will move exactly dollar for dollar with the stock as it rises. So if stock XYZ goes from 67.50 to 68.50, your position using this synthetic long stock position using options will increase in value exactly $1 as well, theoretically. It doesn't always happen, but eventually it will you'll also get a 1 point increase in your option position. All right, so that's the calls and puts at the 55 strike price. Now, what about the calls and the puts? I'm sorry, the calls and the puts at the 55 strike price. What about the calls and puts at the 75 strike price? Well, if we have a call out of the money and we purchase that call, it has a positive delta. But because we're selling the call, it has a negative delta because it makes money when stocks go down. So in this particular case, we have a call that is out of the money and we're selling it, so we have a negative delta. Now, because it's out of the money by about 7.5 points, it probably has something like maybe a 0.23 delta. And in this case, because we are selling the call, it has a negative delta. And the put, because it's in the money and we're buying it, a put has a negative delta. And so because we're buying it, it has a negative delta. And that probably, I'm just estimating here because it's about 6.5 points in the money, or 7.5 points in the money. It has probably something like a 77 delta, minus 77 delta. Oops. Put the minus sign in front. And so the delta here then is also going to be 1 if you add these two together, but it's really a negative 1. So, for example, if you sell, let's ignore the 55 strike price for a second. We'll just concentrate on the 75 strike price. If you sell a call at the 75 strike price, you buy a put at the 75 strike price at the same strike price, you have a negative 1 delta, which means that for every dollar that stock XYZ drops in price from 67.50, say, to 66.50, your position on this will also increase in profits by $1. Does anybody know what this spread is called? This particular selling a call at a strike price and buying a put at the exact same strike price. Tori, you're right. Yes, it is a synthetic short position. So because it has a delta of negative 1, it will increase in value 1 point for point, for each dollar that the stock drops. So we have an interesting dynamic here with the box spread, because we're buying a call, selling a put, we have a delta of 1. We're selling a call and buying a put, we have a delta of negative 1. You can't, when you put a trade on like this, you can't, it doesn't really make any money once you put it on. It can't lose money, it can't make money. It does fluctuate, it won't fluctuate in value until you get to expiration. And that's one of the reasons why only floor traders can really put this kind of a trade on. Generally, you're not going to be able to put an order in to get, to put the order in for all 4 of these options at these strike prices and get them for less than 20 points. A floor trader can do it because they don't pay commissions. And so if they can buy this box spread for anything less than $20, they have a guaranteed profit. If they can buy it for $19.50, if they can buy it for $19, they can buy it and make a $1 profit guaranteed at expiration. Because between the time that they put this box spread on, if they get it for less than $20, until it goes to expiration, this box spread will not move. It will not increase in price. It will not decrease in price. It will stay at the price that they bought it. So if it's $19.50 they bought it for, it will stay that way until expiration. Because if you're long and short 100 shares of stock at the exact same time, there is no profit there to be made. When it gets to expiration, they have to. This 20-point box spread has to be worth 20 points. So if you bought it for $19.50, a week or 2 weeks before expiration, or months before expiration, at expiration, it has to be worth 20 points. And so let's say the stock doesn't do anything, it stays at 67.50 at expiration. Well, the 75 calls that you sold and the 55 puts that you sold are going to expire worthless, right? So the difference between the 55 call and the 75 put that you bought the difference between those two has to be 20 points, and that's exactly what the spread will turn out to be. Now, if the stock moves dramatically, if it's above 80, now you've got an in-the-money call at the 75 strike price that you sold, and you'll be assigned. And so generally, and the same thing happens if the market goes down below 55, you've got an in-the-money put that you sold that will also be assigned. And so that's why this is a very, very difficult trade for retail traders to use and benefit from and profit from, because it has to be held till expiration in order to realize the full potential profit of the spread. Now, I know some people who have legged into these spreads. So, for example, on the call side, since you're buying a call and you're selling a put, or you're buying a call and you're selling a call, you've got a debit call spread here, and you could buy that leg and then eventually leg into the 75 put and the 55 put. That is also a debit put spread, and so you could leg into it, maybe buying this one for maybe 17 or rather 8 or 9 points, and then buying this one for 8 or 9 points, and now you've got an $18 or $19 box spread, or $20 20-point box spread that you bought for $18 or $19. The problem is that it will not move in price until expiration, because you're long and short delta at the same time. So you have to hold it to expiration, and that's where the problem comes in. Because if your put that you sold or the call that you sold is in the money, you're going to have those assigned, and it's gonna skew your profitability, and it's going to be very difficult to handle the assignment depending on how many that you put on in your account size. So it gets tricky because you have to hold it till expiration. All right. Let me get a drink of water and we'll continue here. So, the box spread is the basis for the three-legged spread. Let's get into the three-legged spread. All we do really is take one of the corners off of the box and mix it up a bit in order to come up with the three-legged box spread. The basic, as I mentioned, now this is just a basic long three-legged box spread. We've got 4 corners here representing the 4 options from the box spread. But instead of actually having, oops, I didn't want to do that. Instead of having 4 options here that creates a box, we're only going to have 3 legs out of the 4 legs. So in this case, what we're going to do is take that one off, and we are going to create a basic long 3-legged box spread using just 3 points and 3 options. The difference between the box spread and the 3-legged box spread is simply that we take off one of the legs, and that's it. Now, in this case, because it is a basic long 3-legged box spread, we're actually going to be buying the call. We're going to be selling a put. Now, you'll recognize this, right? You recognize this because it is a synthetic long stock position. But the difference is, because we don't have the other call that we're going to be selling, we're actually going to be buying a put, and that put is basically there for protection and also for margin reasons. It's for protection, number one, and it's for margin reasons number 2, because if you sold this particular put without buying a put is for in a spread situation in the same expiration, the margin requirements are going to be quite high because you're basically selling a naked put, and so you have an unlimited potential for loss, and your broker generally won't let you do it unless you have a very, very large account. So we buy the put, but that actually works in our favor because it gives us a clearly defined loss on this trade if it goes against us. And it's also the reason why we don't have to put any stops in on the spread itself. It gives us the protection that we need in order to make the trade work. So we're buying 2 puts and we're selling, we're buying 2 options, a call and a put, and we're selling 1 put. Now this has some favorable economics to it, as I mentioned. Number 1 is if the stock doesn't move that much, if we've put this basic long 3-legged box spread on XYZ stock here at 67.50, if this stock doesn't move, we've sold a put at the 65 strike price that will probably generate some theta for us, it'll generate some income for us. Also, because it is a higher strike price than the put that we bought, we essentially have a credit spread here, which goes to offset the cost of buying our call. So it's very, very favorable economics here, the way that this is structured. Selling the put, buying a put, and creating a credit spread here helps us to offset the cost of buying our call. Let's take a look at the profit and loss graph on this particular 3-legged box spread. This is a long 3-legged box spread. This is the profit and loss at expiration on a long trade per contract. This is just using just one contract. If, like I said, the stock does not move, we have a maximum loss of approximately $230. Now this is an average that we can take, and this is only an example. I'm not using actual numbers here. But because we have sold this particular put at the 65 strike price, it actually helps us if the stock does not move. So we've got a window of opportunity here to have a minimal loss if the stock does not move of $230. Now if it goes against us, our maximum loss in this example is $520. It's going to be more than if it stays the same, because if it goes against us, obviously we have the put. If the stock goes down instead of going up, we have the put here that we bought as protection, and that's exactly what it's meant to do. It's meant to protect us if the trade goes against us, and it's meant to protect us from a maximum loss that could be much larger than that, because we sold a naked put. Now here's where the fun comes in, because if the market starts to move in our favor, in this case we're looking for the market to rise because we have a long 3-legged box spread on. If it moves 5%, we've hit a target of $1,480, and that's what we always look for. Our target profit is always going to be maximized when the stock moves in our direction 5%. And that's why I have 5% down here. That's our target. Now, we can use some discretion to continue the trade if it's working in our favor, but that is our initial profit target. We don't have to worry about the losses because we know what our maximum loss is going to be. We do not have unlimited loss potential in the 3-legged box spread. We do have a profit target though. And so if the market moves against us, we can afford to be patient and wait for it to come back in our favor, because we know exactly we have a clearly defined loss on the trade. And if the market continues to go in our favor after we've hit our profit target, we can let it run. And if we are right, and we are really right about it, we have unlimited profit potential on this particular trade. The three-legged box spread, like I mentioned, has favorable economics. Clearly defined loss, unlimited profit potential to the upside. So at $2,960 at 10% move. Now, a 10% move isn't all that big. Even a 5% move is pretty small, actually. And I'll share with you exactly what type of stocks and ETFs we look for to make these types of moves. But it's in our best interest that we get a stock that is going to move 5 or 10% so we can make our maximum profit and beyond. Now, if it goes down even more, let's say it drops out of bed. Let's say we have a short three-legged box spread on, and all of a sudden, and you've probably seen this hundreds of times, stock is trading at $120, and all of a sudden it's trading at $40. And, well, we have just hit the jackpot. And that's one of the reasons why I like three-legged box spread so much, is because once in a while we can hit the jackpot. It's just like winning the lottery. And I'll show you an example of a trade that actually we did that was like winning the lottery. Here is a basic short three-legged box spread. Now remember, these are examples only. We take one of the legs off. Now we have 3 legs. In this case, since it's a short three-legged box spread, we're actually selling this call. And we are buying both a call and a put. And now we have, if we're selling a call and we're buying a put at the exact same strike price, we have a synthetic short position, right? And we buy a call against the call that we sold as protection, just like we did in a long three-legged box spread. In this case, we hope to profit as XYZ stock drops in price. Now let's take a look at the profit and loss graph for this three-legged box spread. Basically the same scenario. If it does nothing at all, we have a minor loss if the stock does not move. If it goes against us, we have a maximum loss of $520 in this case. And it doesn't matter how low the stock goes, or how high the stock goes, rather, because we've got a short three-legged box spread on. So let's say we buy the three-legged box spread, short three-legged box spread. The stock is trading at $67.50, and all of a sudden it goes to 100. It goes up to 100. In our case, our maximum loss is $520. It doesn't matter how high that stock goes. It could go to 1,000, and our maximum loss is going to be $520. If it goes in our favor, what we're looking for is a 5% move. That's why volatility is so critical when it comes to three-legged box spreads. In fact, it's critical for any type of trading that you're doing. But in our case, the study of volatility for this particular system is so critical because we are looking for a 5% move, no matter what kind of position we're in or what stock or ETF we're using. And as soon as we hit that, we've got our profit target. Now, if it continues to work in our favor, or all of a sudden we get an overnight move in which the stock drops by 30-40%, well, then we've hit the jackpot again, and we've made our maximum amount of money. In fact, if it continues to drop, we'll make a lot of money. In fact, there's unlimited profit potential as well. Well, I should say unlimited on a short three-legged box spread. If the stock goes to 0, we're going to make a lot of money. It's not unlimited, but it is going to be a lot of money. Okay? So that's why the three-legged box spread really is one of the best strategies out there. Clearly defined loss. If this works against us and it goes against us for a very long period of time, then it doesn't matter how much it goes against us. We are going to see the same loss on this stock, no matter how low it goes. And I apologize, I'm having my lawn mowed while I'm doing this. You probably hear the lawnmowers in the background. Sorry about that. All right, now, with this setup, let's say you really want to get into three-legged box spreads, which I highly recommend, but you have to know your market. Number one, where's volatility? Because you want to be able to make that 5% move. You want that stock that you choose in order to make the spread work, go up 5% or go down 5%. So you have to know what kind of market you're in. Number two, trade selection. Variations are very important. So for example, this is a basic, like I said, it's a basic long three-legged box spread, but there are variations to this spread that can work in your favor if you know how to do it. So you can do a short three-legged box spread, and sometimes because of volatility, because of the IV levels of the stocks or ETFs that you want to put the three-legged box spread on, you can't get exactly this scenario. It's going to be either going to be pricey, or the premiums themselves change the profit and loss graph. And so it's important to understand that there are variations of the three-legged box spread, and I'm going to give you one of the variations in just a few minutes. Number three, the setup is very, very important. Of course, we need liquid options. We need options that are extremely liquid for the trade itself. It has to be. You don't want to be able to. You don't want to get into a situation in which the spread between the bid and ask price on your options is very, very wide. You want to have extreme. You want to have something that's liquid, so that you can get into and out of the position anytime that you want. Also, we never use 2x or 3x ETFs. So we never do the double or triple ETFs. And the reason for that is very simple. Double and triple ETFs are meant for day trading only, not for long-term investing. Since we're using longer-term expiration dates for three-legged box spreads, using a 2x or a 3x will definitely skew our results, and it will hurt our results, because in order for these ETFs to get double and triple the returns in the market, they need to go in and purchase and sell option contracts and futures contracts in order to generate those 2x and 3x returns on a daily basis. When the options and the futures that they've purchased to generate those kind of returns expire, there's a resetting of the ETF. The resetting of the ETF generally hurts the performance over the long term. So I highly, this is not a system that you would use, and I would caution you against ever using them in any situation, really, the 2x and 3x ETFs. And then we look for ETFs or stocks in the $100 price range because of the 5% rule. Remember, we want this to drop 5% when we put a three-legged box spread on it, or we want it to go up 5% when we put a three-legged box spread on it. So there's we really need a 5% move in the market in order to hit our profit targets. And that's so important. And so let's use this example. Okay, so if you're trading, if you look at a stock and you want to put a three-legged box spread on it and it's trading for $20, well, a 5% move in a $20 stock is only $1. A 5% move in a $100 stock is $5. And so we need the movement, $5 movement in the stock in order to hit our maximum profit. So we need stocks, and at least in the $100, we've put three-legged box spreads on stocks that go for $300 or $400. It doesn't make any difference to us, but we do need them to move. We need the 5% to be a substantial number. All right, so the three-legged box spread uses just three options, as I've shown you. Either two puts and a call, or two calls and a put. Excuse me. Okay, so here's a variation. A three-legged box spread example is a variation. Let's say we are doing a three-legged box spread. This is going to be a. Oops, I got this backwards. Here we go. This is going to be a short three-legged box spread. We have a synthetic short position here, and we have our call at a higher strike price for protection. In this case, when we look at the profit and loss graph, because of maybe volatility is a little bit is high, it's in the high range. That's why knowing what kind of market you're in is so important. We cannot get a favorable profit and loss graph based on these selections. So what we might want to do is simply move our puts up and create a slightly skewed three-legged box trade, so that now when we move the put up by a strike price or down to a lower level to the 165 strike price, all of a sudden it becomes favorable to us. And so that's how you can use variations depending on volatility in order to make the three-legged box trade work. And there are literally dozens of variations on the three-legged box spread that we could talk about and discuss, but we're already over an hour into this webinar, so it would be very difficult to go over every single scenario. But just realize that there are variations to the box spreads that you can use depending on volatility, depending on which strike prices you use. You always want to have a favorable profit and loss at expiration graph like this one. Now, when you're since we are trading longer term expirations, we never hold them to expiration. This is profit loss at expiration, but it's also during the trade. So we generally do not hold them that long. Typically a three-legged box spread that we put on, if it's a long three-legged box spread, we give it a little bit more time, but generally the expiration dates that we're looking for are anywhere from 6 to 9 months out. We don't use 30 days to expiration. We don't use options that are 60 days to expiration. We don't use 90 days. Generally, we're looking at anywhere from 6 months to 9 months in expiration. So, again, the benefits: forgiving economics, high profit and loss ratio, flexibility, longer expirations, gives us time to be right. We have defined profit targets, easy open and closing of trades, no overnight worries, big moves or assignments, clear entry and exit points, easy to put on and take off, no complicated legs involved, no adjustments are necessary. It works or it doesn't work. And then we have once daily monitoring with alerts minute by minute, not minute by minute. We have relaxed, informed, and thoughtful trading, simple execution, makes entry easy, and single contracts keeps commissions low. Let's take a look at the track record for the last, let's see, about 84 trades here that we've looked at over the last few months. Here are the symbols of the stocks and ETFs that we've traded, the number of trades, profit and loss, average profit, average loss, and the net profit and loss for each one of those trades that we've created. Let's take a look at the diamonds first. Now again, I want to remind you that we're only using single contracts for each one of these trades. If you used 2 contracts, for example, you would double these numbers. If you use 3 contracts, you'd triple these numbers. Let's take a look at the diamonds first. We did 11 trades over this time period. We've actually ended up with a profit 7 times, and we've ended up with a loss 4 times. So basically, we've actually not quite a 50-50 ratio, right? We've had a few more profits and losses, but we still had 4 losses out of the 11 trades that we've done. Now, of the profitable trades, the average profit was $1,163. The average loss for the 4 losses was $528. But we still ended up with a net profit of $6,029 on those 11 trades, even though we lost 4 times because of the forgiving economics of this particular type of spread. Let's take a look at GLD. We did 3 trades. We won 2 out of the 3. We had 1 loss. The average profit on the 2 that we did generate a profit on was $1,547. The average loss was $430. Our net profit, because we did have a 2 winners at a fairly good average profit, was minus our losses. Okay, this is net profit after we've added up our profits and our losses, was $2,664. Now, this is the one that I told you about that you can basically win the lottery with. You can win the jackpot. We did a trade on Apple. We did 4 trades on Apple, actually. 1 was profitable out of the 4. That's it. Just 1. We had 3 losses. Out of the 4, we had 3 losses. But that 1 trade generated $17,362 in profit. Our average loss of the 3 that we lost was $2,554. So our net profit, even though we only won 1 out of 3 trades, was $9,700. And that also skews some of the average profit and loss rate down here, because our average profit over, like I mentioned, over hundreds of trades is about $1,340. Average loss is about $430. And then the SPY. So you can read down these. Even though our ratio, we won out of 12 trades, we won 8, we lost 4. Average profit is $1,106. Our average loss is $342. Generated a profit of $7,480. Even though we were wrong 4 times out of 12, we still generated a healthy profit because of the forgiving economics. Let's go down to one here that we lost more than we profited from. That was XAU. We did 4 trades on that. We ended up with a profit only 1 time. We lost 3 trades. Our average profit was very low. It was only $875, and we only did that once. Our average loss was $422, and we lost 3 times on that. And we ended up with a loss of $391 on those 4 trades. But that's it. $391 because of the forgiving economics. So even when you're wrong most of the time, in fact, you're wrong 3 times more than you are right, the favorable economics of the trade help to mitigate major losses. It doesn't eliminate losses, and you can lose money, but it does help, because of the favorable economics, lose as little money as possible. You can see the other ones here that we generated. Basically, let's go down to the totals. Out of 84 trades for this example, 51 were profit, 33 were losers. Our average profit, skewed by Apple, obviously, $2,783. Average loss, $662. Again, skewed by this Apple trade. Total net profit and loss, $55,439 over 84 trades. So you can see that, once again, the average profit, the risk to reward ratio here is close to 3 to 1. 662 average loss, average profit 2783, makes this work in the long term. Okay, now let's get into some interesting stuff. Let's go over to the TOS platform for a second, and I'm going to show you an example of a trade and how we set it up here just recently. All right, let's go in here and take a look. Now, we set this up. This was one of the very first trades I did back in. Well, I've been trading this longer than this, but it was one of the more interesting trades in December 15th of 2011. Goldman Sachs has been was in the close to $200, and then it started falling off here, and it looked like it was creating a little bit of a bottom here, a little triple bottom, and so we put the trade on in December 15th in fact, we were wrong after a few days here, right in this area here, December 15th, and we put it on for expiration in July of 2012. Here are the expiration dates. Here are the three options that we used. This was a long three-legged box trade. And we had it went against us almost immediately, and then it started coming back again. As GS rose, we started profiting, and in this case, we ended up with a profit of $2,384. So the put that we sold, as you can see, generated $1,165 in profit because the stock did rise, and we sold that put. The put we bought for protection lost $811, which it should, because that was protection if the trade went against us. And we had a profit on the long call that we purchased of $2,030 for a total profit of $2,384. These are the kind of trades. So we put this on for a 7-month expiration. And we ended up getting out of it in March 26th. So we ended up holding this from the end of close to the middle of December to the end of March. So a good time period there. But because we can use longer expirations, we can get we have time to be right. All right, let's go back here. Decision and selection, consistent and reliable profits, as you can see, is one of the benefits of the three-legged box spread. And now let's talk a little bit about portfolio and money management. Now, based on your account size, this is in my account size, this is generally how I would allocate trades to different account sizes. So an account from $5,000 to $10,000, you would have 1 to 2 of these trades on at any one time. Now, even though we do longer term expirations for these trades, they can move extremely fast, and within a week we can hit our maximum profit target. So even though, let's say we go back here, some of these trades, I didn't put the average length of the trade, which is probably a good thing to do, but the average trade was probably close to 5 to 6 weeks to 7 weeks. Even though we bought longer-term expiration dates, it gave us time to be right, and some trades did end up going 4 or 5 months, but many trades ended up hitting our profit target within a week or two. So it's all over the place. It depends on how quickly the stock hits our 5% target. On a portfolio of 10,000 to 25,000, I recommend 2 to 3 of these trades. 25 to 50,000, 4 to 5. 50,000 to 100,000, 5 to 7. And 100,000, 250,000, 7 to 10. And anything over 250,000 really is up to you. But that's generally how I would allocate the number of trades based on portfolio size. Now, what's next? Well, I highly recommend that you actually go into and do some trades on your own. Now, there are so many different variations, though, it can be a little complicated. And really, even though we've been doing this now for over an hour and a half, we really barely scratched the surface of the three-legged box spread itself, because of the variations, the volatility that's involved, and so forth. It really can be a little bit complicated if you're going to be doing it on your own. And so I highly recommend that you do it very, very slowly. Get involved in a single trade and do it, and monitor it and watch it very carefully and keep an eye on it, and try it out for yourself. And that's the only way that you're really going to learn.